We will now turn our attention to Session 2, Assets. In this session, we will cover some of the standards related to assets, including property, plant, and equipment, intangible assets, leases, service concession arrangements, inventories, agriculture, and investment property. I will now turn it over to Camilla, who will take you through the first half of the asset session.
Thank you, Antonella. Before we get into the standards themselves, let's look at the asset definition. An asset is a resource presently controlled by the entity as a result of a past event. The definition of an asset can be dissected into key characteristics. First one, they embody resources. And as you can see on the slide, a resource is an item with service potential or the ability to generate economic benefits. Physical form is not a necessary condition of a resource. Second, they are presently controlled by the entity. And third, they arise from a past event.
Camilla, thank you for that. Before you go to the next slide, can you tell us a bit more with respect to what you mean when you say that an asset embodies resources?
Yes, of course. Resources may be financial resources, including cash, claims to cash, investments, and any other resources that can be used to settle liabilities as they come due or to finance the provision of future goods and service. They may be physical resources with the ability to generate future net cash flows or that will be consumed in the provision of future service in the normal course of operations, including land, buildings, equipments, books, etc. And the third one, non-physical resources or intangible resources representing recognizable rights to future economic benefits and service potential. Examples of intangible assets that may be recognized by public sector entities include licenses, computers, softwares, etc. Is it clear now?
Yes, thank you, Camilla, for that clarification. It was very helpful. And what about control? What does being presently controlled by the entity entail?
That's a very good question. Control of an asset has two main aspects. The first one, the entity can use or otherwise benefit from the resource in pursuit of its objective, having the right to obtain the benefits from the asset. And the second is the entity is able to exclude or otherwise regulate the access of others to benefits arising from the resources by preventing others from obtaining the benefits.
Thank you, Camilla. And lastly, can you take us through the last key characteristic, being that an asset arises from a past event?
Yeah, of course. The occurrence of a past transaction or other event is considered to be evidence supporting the existence of a present resource. Transactions or events expected to occur in the future do not in themselves give rise to assets. This will often be the purchase, a contract, or legislation. Service potential is the ability of an item to contribute to the organization's objective. It does not need to generate revenue. In some jurisdictions, hospital will be resources because they can be used to generate revenue as patients are charged. In other jurisdictions, there are no charge and hence no revenue, but the hospital is still a resource because it enables the health ministry or similar organization to meet its objective. Once it's determined that a resource meets the definition and has the key characteristics of an asset, a determination must be made on whether the recognition criteria are met. The recognition criteria are on the slide. The concept of probability is used in the recognition criteria to refer to the degree of uncertainty that a future economic benefits associated with the asset will flow to the entity. The concept is in keeping with the uncertainty that characterizes the environment in which an entity operates. Probable means that an inflow of resources is more likely than not to occur. That is, the probability that the event will occur is greater than the probability that it will not. With respect to the second criteria, an item may not be recognized in the financial statements because a reasonable estimate cannot be made of the amount involved. However, just because an estimate is involved does not mean the measurement is unreliable. Here we have a decision tree to summarize all we have discussed so far. Consider the item in the context of the definition of an asset. If it does not meet the definition, then nothing further is required. If the item meets the definition of an asset, then you will need to determine the appropriate IPSAS to use in recognizing the asset in the financial statements.
Thank you, Camilla. Before you go to the next slide, I see that on this particular slide that when making an assessment of whether an asset meets the definition of whether or not an item meets the definition of an asset, the entity should consider if it's a monetary or non-monetary asset. Can you talk a bit more about this?
Yes, of course. Monetary assets versus non-monetary assets. So monetary assets are units of currency, other assets to be received in fixed or determinable units of currency. For example, cash, accounts and loans receivable, temporary investments. All other assets are non-monetary. Monetary assets are accounted for using IPSAS 28 to 30 on financial instruments and IPSAS 41. So now let's start looking at the individual IPSAS, and we are starting with IPSAS 17, Property, Plant and Equipment. Here on the slide, we have the definition of PP&E, that it's tangible items that are held for the use in the production or supply of goods or service, for rental to others, or for administrative purpose, and are expected to be used during more than one reporting period. Weapons, systems, and infrastructure assets meet the definition.
Camilla, before you go to the next slide, can you tell us a bit more about weapon system and infrastructure assets?
Sure. Weapon systems include vehicles and other equipment such as warships, submarines, military aircraft, tanks, missile carriers, and launchers that are used continuously in the provision of defense services, even if their peacetime use is simply to provide deterrence. With respect to infrastructure assets, while there is no universally accepted definition of infrastructure assets, these assets usually display some or all of the following characteristics. They are part of a system or network, they are specialized in nature and do not have alternative use, they are immovable, and they may be subject to constraints on disposal. Examples of infrastructure assets include road networks, sewer systems, water and power supply systems, and communication network. IPSAS 17 has a few scope limitations. IPSAS 17 does not apply to biological assets related to agricultural activity, with the exception of bare plants, which are in scope of IPSAS 17, mineral reserves such as oil, natural gas, and similar non-regenerative resources.
Thank you, Camilla. And you mentioned biological asset. Can you tell us what that is?
Of course, a biological asset is a living animal or plant. Generally, biological assets are related to agricultural activity. These are dealt with in IPSAS 27, Agriculture, that will be covered later in this workshop. However, a biological asset could also exist outside agricultural activities. For example, a police department may use police dogs in a canine unit. IPSAS 17 does apply to PP&E used to develop and maintain biological assets and mineral reserves. The general asset recognition principles apply equally for PP&E as any other assets. IPSAS 17 requires an entity to apply the general asset recognition principle to all property, plant, and equipment costs at the time they are incurred, including initial costs and subsequent expenditures. From an initial measurement perspective, an item of property, plant, and equipment that qualifies for recognition as an asset shall be measured at its cost. The cost of an item of property, plant, and equipment is the cash price equivalent and comprises its purchase price, including import duties, taxes, net of trade discounts and rebates, any cost directly attributable to bringing the assets to the location and condition necessary for it to be capable of operating in the manner intended by management, and the estimate of obligations associated with retirement, disposal, or abandonment. The requirements for measuring an item of PP&E in non-monetary transactions are complex and beyond the scope of this workshop. An entity shall choose either the cost model or revaluation model as it is accounting policy and shall apply that policy to an entire class of PP&E. Under the cost model, the original cost is carried forward and the carrying amount is original cost less accumulated depreciation and impairment losses. Under the revaluation model, the item is revaluated at fair value and the carrying amount is reevaluated amount less subsequent accumulated depreciation. Depreciation is based on the fair value at the date of revaluation and subsequent impairment losses. After initial recognition of an asset, the revaluation model is only appropriate if the fair value of an item of property, plant, and equipment can be measured reliably. An entity does not have to apply the models consistently across all classes of PP&E. Let's look at the next slide and see how both models differ from each other on the initial and subsequent measurements. As you can see on the table, under both models, an item of PP&E that qualifies for recognition as an asset is initially measured at its cost in accordance with IPSAS 17. Cost is the amount of cash or cash equivalents paid or the fair value of the other consideration given to acquire an asset at the time of its acquisition or construction. For subsequent measurement, under the cost model, an item of PP&E is measured at original cost less accumulated depreciation and impairment losses since recognition. Under the revaluation model, an item of PP&E is measured at fair value at date of revaluation less accumulated depreciation based on revaluated amount and impairment losses subsequent to the revaluation date.
Thank you, Camilla, for clarifying the distinction between the two models. I was wondering, which one is most used by entities?
Great question. Public sector entities and commercial enterprises predominantly use the cost model because of its reliability, understandability, simplicity, and cost effectiveness from an accounting perspective. All PP&E except land is subject to depreciation. The depreciable amount of an asset is expensed on a systematic basis over its useful life to surplus or deficit for each period unless it's recognized in the carrying amount of another asset. The residual value and the useful life of an asset should be reviewed at least at each annual reporting date, and if expectations differ from previous estimates, the changes shall be accounted for as change in accounting estimate in accordance with IPSAS 3, accounting policies, changes in accounting estimates, and errors. Depreciation of an asset begins when it's available for use. Depreciation of an asset ceases when the asset is derecognized. Therefore, depreciation does not cease when the asset becomes idle or is retired from active use and held for disposal unless the asset is fully depreciated. The carrying amount of PP&E is derecognized on disposal or when no future service potential or economic benefits is expected from its use or disposal. The gain or loss arising from the recognition of an item of PP&E should be included in surplus or deficit when the item is derecognized. Under the recognition principle for PP&E, an entity recognizes the cost of replacing part of the PP&E in the carrying amount when that cost is incurred if the recognition criteria are met. The carrying amount of those parts that are replaced is derecognized in accordance with the derecognition provisions. Let's now turn our attention to the PP&E disclosure requirements. The primary disclosures required for each class of PP&E reported in the financial statements include for each class the measurement basis, the depreciation methods, the useful lives or the depreciation rates used, gross carrying amount and accumulated depreciation at the beginning and end of the reporting period, reconciliation of opening and closing balances, specific disclosures for the revaluation model, and other disclosures such as restrictions on title, contractual commitments, etc. IPSAS 17 includes an illustrative example of disclosures. An entity may incur debt and related borrowing costs associated with the acquisition, constructions, or production of a PP&E. IPSAS 5, borrowing costs, prescribes the accounting treatment for borrowing costs.
Wow, Camilla, that's a full other standard for us to deal with. Can you tell us what is relevant from a PP&E perspective?
Yeah, of course. I know it might sound too much, but it's not really. IPSAS 5 allows two alternatives for recognition of borrowing costs. One is the benchmark treatment, where borrowing costs are recognized as expenses in the period in which they are incurred, regardless of how the borrowings are applied, and the allowed alternative treatment, where the borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset are included in the cost of the asset.
Thank you, Camilla, for talking us a bit through the two treatments. Now, can you tell us, is the benchmark treatment preferable over the allowed alternative treatment?
IPSAS offers choices in the application of some of their standards. The preferred choice is labeled as the benchmark treatment, and the other choice allowed alternative treatment. Following either would still mean that an entity is compliant with IPSAS 17. When a public sector entity adopts the allowed alternative treatment under an IPSAS, that treatment should be applied consistently to all borrowing costs that are directly attributable to the acquisition, constructions, or production of all qualifying assets of the entity. A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Examples of qualifying assets that are PP&E include such items as office buildings, hospitals, infrastructure assets such as roads, bridges, and power generation facilities. The borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset are those borrowing costs that would have been avoided if the outlays on the qualifying asset had not been made. When an entity borrows funds specifically for the purpose of obtaining a particular qualifying asset, the borrowing costs that directly related to that qualifying asset can be readily identified. Impairment is a loss in the future economic benefits or service potential of an asset, over and above the systematic recognition of the loss of the asset's future economic benefits or service potential through depreciation. At each reporting date, entities are required to assess whether there are any indicators that an item of PP&E may be impaired. An entity apply IPSAS 21, impairment of non-cash generating assets, or IPSAS 26, impairment of cash generating assets. Although the definition of impairment is the same for both a non-cash generating asset and a cash generating asset, the requirements for assessing whether an asset is impaired, the measurement of impairment and its recognition are different depending on its nature. IPSAS 21 and IPSAS 26 contain a list of key indicators that an impairment loss may have occurred for non-cash generating and cash generating assets, such as technological, legal, or policy changes, obsolescence, physical damage, change in use, cessation of construction, poor economic service performance, and increased market interest rates. In assessing whether there is any indication that an asset or group of assets may be impaired, an entity shall consider at a minimum external and internal source of information. The list of indicators are not intended to be exhaustive. An entity may identify other indications that an asset may be impaired. If any of those indications of impairment are present, an entity is required to make a formal estimate of recoverable amount or recoverable service amount. This takes us to the end of PP&E session. Our next topic on the agenda is intangible assets. IPSAS 31 focuses on recognition of acquired or internally generated intangible assets that meets the asset definition and the recognition criteria. Under IPSAS 31, an intangible asset is an identifiable non-monetary asset without physical substance. Not all the items meet this definition of intangible assets under IPSAS 31. An identifiable intangible asset is one that is capable of being separated or divided from the entity or sold, transferred, licensed, rented, or exchanged, or arises from binding arrangements that are contracts. Intangible assets must be identifiable, and in order to be recognized as an intangible asset, it must be controlled by the entity. There are cases in the public sector where an intangible asset is acquired under a binding arrangement, and this definition still applies. Public sector entities often acquire computer software licenses. These generally meet the definition of an acquired intangible asset, with the exception, it's rare for public sector entities to acquire intangible assets under a binding arrangement. Most acquired intangible assets will meet the criteria for recognition. Examples include software, brands and trademarks, and in-process research and development. With the exception of software, it's rare for public sector entities to acquire intangible assets. Intangible assets are measured at cost on initial recognition. If they are acquired through a non-exchange transaction, the deemed cost is the fair value of the intangible asset at the date of acquisition. Recognition of an internally generated asset has stricter criteria. Expenditure incurred during the research phase of an intangible asset cannot be capitalized. Expenditure incurred within the development phase of an intangible asset can be capitalized where the recognition criteria are met.
And Camilla, can you tell us this criteria that is needed to demonstrate that an entity is in the development phase?
Absolutely. Expenditure on the development phase can be capitalized as an intangible asset where the recognition criteria are met. To recognize expenditure as an intangible asset, IPSAS 31 requires an entity to be able to demonstrate the following: the technical feasibility of completing the intangible asset so that it will be available for use or sale, its intention to complete the intangible asset and use or sell it, its ability to use or sell the intangible asset, how the intangible asset will generate probable future economic benefits or service potential, the availability of adequate technical, financial, and other resources to complete the development and to use or sell the intangible asset, and its ability to measure reliably the expenditure attributable to the intangible asset during the development. Most subsequent additions or replacement of intangible assets are usually expensed.
Camilla, if I can just pause you for a moment there. Really? I wouldn't think so. Like, I would think additions would be capitalized rather than expense. Can you tell us why this happens?
Yeah, I understand what you're saying. This is because they don't meet the recognition criteria. They are likely to maintain the expected future economic benefits or service potential embodied in an existing intangible asset. In addition, it's often difficult to attribute subsequent expenditure directly to a particular intangible asset rather than to an entity's operation as a whole. However, if the expenditure clearly enhances the service potential of original assets, then the recognition criteria may be met. If so, the cost should be capitalized. Intangible assets may have a finite or indefinite useful life. Where an intangible asset has a finite useful life, it is amortized over that useful life. Where an intangible asset has an indefinite useful life, it's not amortized. However, it's reviewed for impairment at least annually. Public sector entities may acquire intangible assets through public sector combinations or acquisitions. The accounting for public sector combination is set out in IPSAS 40 public sector combinations. When an intangible asset is acquired through a public sector combination, the cost of the intangible assets is the fair value at the acquisition date. The probability of future economic benefits or service potential flowing to the entity is always considered to be satisfied for intangible assets acquired in a public sector combination because it expects there to be economic benefits from the combination. Intangible assets acquired in a public sector combination are recognized separately from goodwill. If an entity cannot identify the intangible asset, it forms part of goodwill and it's not recognized separately. And this takes us to the end of the intangible asset session. The next item on the agenda is leases. The primary issue in accounting for leases is the classification of a lease as either a finance lease or operating lease. We are going to look at each one of them as part of this session. IPSAS 13 requires that lease agreements are accounted for in accordance with their economic substance rather than legal form.
Camilla, if I can just pause you for another second here. What does that mean? Can you talk a little bit more about that?
Yes, that means that whether a lease is an operating or finance lease depends on whether the risks and rewards of ownership of the related asset lie with the lessee or the lessor. Risks include the possibilities of losses from idle capacity, technological obsolescence, changes in value because of economic conditions. And rewards are expectation of service potential or profitable operation over the asset's life, gain from appreciation in value, or realization of a residual value. When a lease includes both land and building elements, an entity assesses the classification of each element as a finance or an operating lease separately. A lease could include a finance lease for the building element and an operating lease for the land element.
Thank you, Camilla. And can you tell us what is a finance lease?
Yes, of course. A finance lease transfers substantially all the risks and rewards of ownership of an asset to the lessee. An operating lease does not. Although the legal form of a lease agreement is that the lessee may acquire no legal title to the leased asset, in the case of a finance leases, the substance and financial reality are that the lessee acquires the economic benefits or service potential of the use of the leased assets for the major part of its economic life in return for entering into an obligation to pay for that right an amount approximating at the inception of the lease the fair value of the asset and the related finance charge. A few examples of situations that individually or in combination would normally lead to a lease being classified as a finance lease. But please note that the lease does not need to meet all these criteria in order to be classified as a finance lease. First one, the lease transfer ownership of the asset to the lessee by the end of the lease term. Second one, the lessee has the option to purchase the asset at a price that is expected to be sufficiently lower than the fair value at the date the option becomes exercisable for it to be reasonably certain at the inception of the lease that the option will be exercised. Third one, the lease term is for the major part of the economic life of the asset, even if the title is not transferred. And the last one, at the inception of the lease, the present value of the minimum lease payments amounts to at least substantially all of the fair value of the leased asset. This list is not exhaustive, and there are other indicators listed in IPSAS 13 leases that you can look in case you are interested. Identifiable finance leases may be part of agreements, and an assessment needs to be performed to determine if it's in a service concession arrangement as they are common in the public sector. Service concession arrangements are discussed later in this workshop. If not, service concession arrangements, then you should use IPSAS 13 leases. Professional judgment is needed to determine the substance of the arrangements when it's not clear. Lessees recognize assets acquired under finance leases as assets and the associated lease obligations as liabilities in their financial statements. At the start of the lease term, The asset and the liability for the future payments are recognized in the financial statements at the same amounts, except for any initial direct costs of the lessee that are added to the amount recognized as an asset. After initial recognition, assets are accounted for under IPSAS 17, PP&E, or IPSAS 31, Intangible Assets. This includes transactions such as depreciation and amortization. Where leased assets may be impaired, IPSAS 21 or IPSAS 26 should be applied. All of these standards were already covered as part of this session. At the initial recognition, the assets and liabilities are recognized at amount equals to the fair value of the leased asset, or, if lower, the present value of the minimum lease payments, each determined at the inception of the lease. The discount rate to be used in calculating the present value of the minimum lease payments is the interest rate implicit in the lease, if this is practicable to determine. If not, the lessee's incremental borrowing rate shall be used. Minimum lease payments are split between the finance charge and the reduction of the outstanding liability. The finance charge is allocated to each period during the lease term to produce a constant periodic rate of interest on the remaining balance of the liability. Now we will move on to operating leases. Lessees do not recognize lease assets or lease liabilities for an operating lease. This is because an operating lease does not transfer substantially all the risks and rewards of ownership of an asset to the lessee. As a result, the lessees recognize lease payments as an expense. By default, expenses are recognized on a straight-line basis. However, if a different basis better reflects the user's consumption of the benefits associated with the lease, these bases should be used.
And Camilla, could you add a bit more color on this different basis that you just mentioned?
Sure. Let's take a look at an example. A lease may not require a lessee to make any payments for the first 2 periods. Such terms provide an incentive for the lessee to enter into a lease. However, this pattern does not reflect the lessee's use of the leased asset and should not be used as the basis for recognition of the lease expense. Until this point, we were discussing the accounting from a lessee perspective. Now we will look at the lessor accounting. When a lessor leases an asset under a finance lease, the lessor derecognizes the asset.
And Camilla, why is that? Isn't the ownership of the asset still with the lessor?
Yes, but the ownership is not what we should be assessing here. There are a few things to notice. First is that it's not a requirement of IPSAS 13. Rather, it's a requirement under the derecognition provisions of IPSAS 17 PP&E or IPSAS 31 Intangible Assets. Second, under a finance lease, the lessor transfers substantially all the risks and rewards of ownership of an asset to the lessee. The lessor, therefore, no longer controls the economic benefits or service potential associated with the asset. It is this loss of control that triggers the recognition. Lessors recognize lease payments receivable under a finance lease as assets in their statements of financial position. A receivable is initially recognized at an amount equal to the net investment in the lease.
And Camilla, if I can just ask you to pause for just a second here. What is the net investment in the lease?
The net investment in the lease is the gross investment in lease discounted at the interest rate implicit in the lease. The gross investments in the lease is an aggregate of A, the minimum lease payments receivable by the lessor under a finance lease, and B, any unguaranteed residual value accruing to the lessor. The interest rate implicit in the lease is the discount rate that, at the inception of the lease, causes the aggregate present value of A, the minimum lease payments, and B, the unguaranteed residual value to be equal to the sum of 1, the fair value of the leased asset, and 2, any initial direct costs of the lessor. The recognition of finance revenue is based on a pattern reflecting a constant periodic rate of return on the lessor's net investment in the finance lease. When a lessor leases an asset under an operating lease, the lessor does not derecognize that asset. The lessor continues to account for the asset under IPSAS 17, PP&E, or IPSAS 31 intangible assets. Depreciable leased assets should be depreciated or amortized in the case of intangible assets in a manner that is consistent with lessor's normal depreciation policy for similar assets. Lessors recognize lease receipts as revenue. By default, revenue is recognized on a straight line basis. However, if a different basis better reflects the manner in which the benefits derived from the leased asset are diminished, this base should be used. The basis used to recognize lease revenue may differ from the basis on which receipts are received.
And Camilla, sorry, if I can just pause you again. And this is actually very consistent with what you discussed in just a few slides previous to this.
Yes, you're right. One difference that is worth highlighting is that the initial direct costs incurred by lessors in negotiating and arranging an operating lease are added to the carrying amount of the leased asset. This amount is recognized as an expense over the lease term on the same basis as the lease revenue. A consequence of this requirement is that the initial direct costs may need to be treated as a separate component of the asset. A sale and leaseback transactions involves the sale of an asset and the leasing back of the same asset. The leased payment and the sale price are usually interdependent because they are negotiated as a package. The accounting treatment of a sale and leaseback transaction depends upon the type of lease involved. If a sale and leaseback transaction results in a finance lease, any excess of sales proceeds over the carrying amount is not recognized as revenue by the seller lessee immediately. Instead, the seller lessee defers the excess and amortizes it over the lease term. This is because the transaction is a means whereby the lessor provides finance to the lessee with the asset as a security. For this reason, it's not appropriate to regard an excess of sales proceeds over the carrying amount as revenue. If a sale and leaseback transactions results in an operating lease and it's clear that the transaction is established at fair value, any gain or loss is recognized immediately. There has in effect been a normal sale transaction, so the immediate recognition of any gain or loss is appropriate. If the sale price is below the fair value, any gain or loss is recognized immediately, except that if the loss is compensated by future lease payments at below market price, it is deferred and amortized in proportion to the lease payments over the period for which the asset is expected to be used. This slide summarizes the disclosure requirements for entities with lease transactions. And that takes us to the end of the Leases session. Let's move to IPSAS 32, Service Concession Arrangements. Service concession arrangements are concluded by way of a binding arrangement, which may include contracts or similar arrangements that confer similar rights and obligations as if they were in the form of a contract. Under the concession service arrangement, the operator uses the service concession asset to provide public services on behalf of the grantor in return for compensation. Compensation could be in the form of payments or the right to earn revenue from third-party users of the service. Let's dig a little deeper and look at the definition of a service concession arrangement. A service concession asset is an asset used to provide public services in a service concession arrangement that is provided by the operator, which the operator constructs, develops, or acquires from a third party or in an existing asset of the operator, is provided by the grantor, which is an existing asset for the grantor or is an upgrade to an existing asset of the grantor. Under IPSAS 32, recognition is based on a determination that the grantor has control over the economic benefits and the service potential of the service concession asset. The grantor controls or regulates what the service the operator must provide with the asset, to whom it must provide them and at what price, and the grantor controls through ownership, beneficial entitlement, or otherwise any significant residual interest in the asset at the end of the term of the arrangement. Once it's determined that the grantor controls these two items, the grantor recognizes an asset provided by the operator and an upgrade to an existing asset of the grantor as a service concession asset. Once the recognition criteria is met, the grantor initially measures the service concession asset that is provided by the operator and an upgrade to an existing asset of the grantor at its fair value. If the asset is an existing asset of the grantor, it is reclassified as service concession assets only when the service concession arrangement involves upgrading an existing asset of the grantor that results in an increase in future economic benefits or service potential of the asset. Is it measured initially at fair value in accordance with IPSAS 32? After initial recognition or reclassification, service concession assets are accounted for in accordance with IPSAS 17, PP&E, or IPSAS 31, Intangible as appropriate. The nature of the liability recognized is based on the nature of the consideration exchange between the grantor and the operator. So looking at the diagram, the liabilities are initially measured at the same amount as the service concession asset. When the grantor compensates the operator for the service concession asset by making payments to the operator, it is a financial liability, and the financial liability model is used to measure it. And this is demonstrated on the left side of the diagram. When the grantor compensates the operator by granting the right to earn revenue from third-party users of the service concession asset or access to another revenue-generating asset, the liability is measured using the grant of right model, and this is displayed on the right side of the diagram.
Camilla, before we go to the next slide, can you talk a bit more about the financial liability model and the grant of right model that you just mentioned?
Yes, I can. There's so much to say about these models. For the purpose of this workshop, I'll try to keep it brief. In a financial liability model, there is an unconditional obligation to pay a specified amount of cash or another financial asset to the operator. This obligation is recognized as a financial liability and measured in accordance with financial instrument standards. In a grant of rights to the operator model, the grantor does not have an unconditional obligation to pay cash or another financial asset to the operator. The service concession arrangement is an exchange transaction in which the grantor has received a service concession asset in exchange for granting a right or a license to the operator to charge the third-party users of the public service that it provides on the grantor's behalf. Therefore, the exchange is accounted for as a revenue-generating transaction by the grantor. Until the criteria for recognition of revenue has been satisfied, the grantor recognizes a liability equivalent to the unearned portion of the revenue that will arise. The earned revenue is recognized over the term of the service concession arrangement. All aspects of a service concession arrangement are considered in determining the appropriate disclosures in the notes. There are minimal disclosure requirements, as you can see on the slide. The disclosures are provided individually for each material service concession arrangement or in aggregate for service concession arrangements involving services of a similar nature. For example, tool collection, telecommunications, or water treatment services. The grantor also applies the relevant presentation and disclosure requirements in other IPSAS as they relate to assets, liabilities, revenues, and expenses recognized under IPSAS 32. And that takes us to the end of the service concession arrangement session. Now, I'm going to pass it over to Iman, who is going to take us through IPSAS 12 inventories.
Thank you, Camilla. Let's start off by looking at the definition of inventories. Inventories are assets which may be in the form of materials or supplies that are to be consumed in the production process, or in the form of materials or supplies that are to be consumed or distributed in the rendering of services. For example, education books produced by a health authority for donation to schools, or educational training course materials. Inventory assets may be those that are held for sale or distribution in the ordinary course of operations, including land and other property held for sale, or inventory may also be found in the process of production for sale or distribution. A few examples of inventories found in the public sector may include military inventories, such as ammunition, missiles, rockets, or bombs, strategic stockpiles, such as energy reserves, stocks of unused postal stamps and currency. Inventories should be measured at the lower cost and net realizable value. The cost of inventories includes all costs of purchase, costs of conversion, and other costs incurred in bringing the inventories to their present location and condition. However, inventories are measured at the lower of cost and current replacement cost where they are held for distribution at no charge or for a nominal charge, or consumption in the production process of goods to be distributed at no charge or for a nominal charge. Also, in the case of non-exchange transactions, an entity may receive inventory items without directly giving approximately equal value in exchange. Under such circumstances, the cost of inventory is its fair value as at the date it is acquired. Fair value reflects the amount for which the same inventory could be exchanged between knowledgeable and willing buyers and sellers in the marketplace.
Iman, before you go to the next slide, you have mentioned terms such as net realizable value, and current replacement cost. Can you talk a bit about these in terms of what they are?
Sure. Net realizable value refers to the net amount that an entity expects to realize from the sale of inventory in the ordinary course of operation. Net realizable value is the estimated selling price in the ordinary course of operations less the estimated cost of completion and the estimated costs necessary to make the sale, exchange, or distribution. Net realizable value for inventories may not equal fair value less cost to sell. Whereas current replacement cost is the cost the entity would incur to acquire the assets on the reporting date. When inventories are sold, exchanged, or distributed, the carrying amount of those inventories is recognized as an expense in the period in which the related revenue is recognized. If there is no related revenue, the expense is recognized when the goods are distributed or the related service is rendered. For a service provider, the point when the inventories are recognized as expenses normally occurs when services are rendered or upon billing for chargeable services. Here on this slide, we have some of the inventory disclosure requirements, which include the accounting policies adopted in measuring inventories, including the cost formula used, the total carrying amount of inventories, and the carrying amount in classifications appropriate to the entity, the carrying amount of inventories carried at fair value less cost to sell, the amount of inventories recognized as expense during the period. And that takes us to the end of this session. Next, we will review IPSAS 27. IPSAS 27 prescribes the accounting treatment and disclosures for agriculture activity.
And Iman, before you start the next slide, can you talk us a bit about what agricultural activity is? Because it sounds really broad. So can you explain it a little bit for us, what it means?
Absolutely. Agriculture activity is the management by an entity of biological transformation and harvest of biological assets for sale, distribution at no charge or for a nominal charge, conversion into agriculture produce or into additional biological assets for sale or for distribution at no charge or for a nominal charge. Next, we'll look at biological assets and the scope of IPSAS 27. Biological assets are living plants or animals. IPSAS 27 deals with the accounting of biological assets except for bearer plants. I will talk a bit more about bearer plants in a minute. For now, I would like to talk more about biological assets. Biological assets are used in many activities undertaken by public sector entities. If biological assets are used for research, education, transportation, entertainment, recreation, customs control, or in any other activities that are not agriculture activities, they are not accounted for in accordance with IPSAS 27. However, when they meet the definition of an asset, other IPSAS should be considered in determining the appropriate accounting. For example, IPSAS 12 for inventories or IPSAS 17 for property, plant, and equipment. IPSAS 27 does not deal with the processing of agriculture produce after harvest and biological assets held for provision or supply of services.
And Iman, before you go to the next slide, can you talk a bit more about these two scope exclusions?
Sure. An example of an agriculture produce after harvest is the processing of, say, grapes into wine by a vintner who has grown the grapes. While such processing may be a logical and natural extension of agriculture activity, the events taking place may bear some similarity to biological transformation. Such processing is not included in the definition of agriculture activity in IPSAS 27. With respect to biological assets held for provision or supply of services, examples of such biological assets include horses and dogs for policing purposes, and plants or trees in parks and gardens operated for recreational purposes. These biological assets are not held for the use in agriculture activity. because they are not routinely managed for the purposes of measuring and monitoring the change in quality and quantity brought about by the biological transformation or harvest as described in IPSAS 27.
Thank you, Iman. That information was very helpful.
No problem. Now, let's take a look at bearer plants in a little more detail. On this slide, we have the definition of a bearer plant. A bearer plant is a living plant that is used in the production or supply of agriculture produce, is expected to bear produce for more than one period, and has a remote likelihood of being sold as agriculture produce, except for incidental scrap sales. Bearer plants are accounted for in accordance with IPSAS 17, Property, Plant, and Equipment. This reflects the fact that the benefits provided by bearer plants are consistent with other property, plant, and equipment.
Thank you, Iman. And before you go to the next slide, I just want to see if I understand what you just said. So based on what you just said, it sounds like animals, let's say a sheep that bears produce like wool, would meet the definition you just outlined. Is that correct?
Not quite. The definition of a bearer plant does not include animals, even if an animal is expected to bear produce for more than one period.
Interesting. Thank you, Iman.
You're welcome. On this slide, we have not only examples of biological assets, but also agriculture produce and products that are the result of processing after the point of harvest. Let's review some of these examples. So sheep are biological assets. They may be used for the production of an agriculture produce such as wool, like you mentioned earlier, Antonella, but it may also be processed after harvest to produce, for example, carpets. Similarly, biological assets may be dairy cattle that is used for the production of agriculture produce such as milk, which can then be processed into cheese.
So Iman, just to make sure I understand everything that you just said, because this is sort of a new area, biological assets, except for bearer plants, and agricultural produce at the point of harvest are in scope of IPSAS 27. But the third column that you see on this slide, the results of processing after harvest, are not in scope. Is that correct?
You are absolutely right. After the point of harvest, IPSAS 12 or another applicable standard is applied. The same general recognition principles for all other assets also apply in this case. Let's recap the asset recognition criteria reviewed in the beginning of the presentation. Biological assets or agriculture produce is recognized when an entity controls an asset that has resulted from a past event, the probable future economic benefits or service potential will flow to the entity, and the fair value or cost can be measured reliably. Let's look at the initial and subsequent recognition of biological assets and agricultural produce. On initial recognition, biological assets are measured at fair value less cost to sell. If we are measuring assets that results from a non-exchange transaction, assets are measured at fair value less cost to sell also. Agriculture produce that is harvested from biological assets is initially measured at fair value less cost to sell at the point of harvest. The grouping of these assets can be done according to their attributes. Subsequent measurement of biological assets would involve measuring the assets at fair value less cost to sell at each reporting date. Agriculture produce is measured at fair value less cost to sell at the point of harvest. Any gains or losses are recognized in surplus and deficit for the period in which they arise. This slide includes some of the disclosures related to IPSAS 27. Some disclosure requirements for biological assets and agriculture produce include gains and losses on initial recognition, consumable or bearer biological assets held for sale, and those held for distribution at no or nominal charge, the nature of activities and estimates of physical quantities, and reconciliations. And this takes us to the end of this session. Next, we will look at IPSAS 16, investment property. Let's begin by looking at the scope of IPSAS 16. IPSAS 16 applies to investment property, including the measurement in a lessee's financial statements of investment property interests held under a lease accounted for as a finance lease, and the measurement in a lessor's financial statements of investment property provided by a lessee under an operating lease. Let's take a closer look at the definition of investment properties. Investment properties are properties such as land or a building or part of a building or both held to earn rentals or for capital appreciation or both, rather than for the use in production or supply of goods and services or for administrative purposes or sale in the ordinary course of operations. Investment property is distinguished from owner-occupied property. Owner-occupied property is outside of the scope of IPSAS 16.
Iman, if I can just pause again for just a second. So from what you said, IPSAS 16 distinguishes investment property from owner-occupied property, which is outside the scope of this standard. And I'm assuming that owner-occupied property is property held by the owner where the owner conducts its business. I mean, I may not be using the right words here, but is that the message that you're trying to portray?
I understand what you're saying. To help you out a little bit, IPSAS 16 defines owner-occupied property as property held by the owner or by the lessee under a finance lease for use in production or supply of goods or services or for administrative purposes. In this slide, you will see we have some examples of investment properties and also examples of items that are not investment properties. Let's look at some examples of investment properties first. Some examples would include land held for long-term capital appreciation, a building leased out under an operating lease for a commercial basis. Next, some examples of items that do not meet the definition of an investment property include property held for sale in the ordinary course of operations, or property that is leased to another entity under a finance lease. This slide provides a quick review of the asset recognition principle. As discussed previously in this presentation, the general asset recognition principles apply equally for investment properties. Let's take a look at how investment properties are measured on recognition. Investment property shall be measured initially at its cost, which is the transaction cost shall be included in the initial measurement. Where an investment property is acquired through a non-exchange transaction, its cost shall be measured at its fair value as at the date of the acquisition.
And Iman, can you talk a little bit more of what is included in the cost of an investment property?
Sure. The cost of a purchased investment property comprises its purchase price and any directly attributable expenditure. Directly attributable expenditure includes, for example, professional fees for legal services, property transfer taxes, other transaction costs. The cost of investment property is not increased by startup costs unless they are necessary to bring the property to the condition necessary for it to be capable of operating in a manner intended by management, or operating losses incurred before the investment property achieves the planned level of occupancy, or abnormal amounts of wasted material, labor, or other resources incurred in constructing or developing the property. An investment property may be acquired through a non-exchange transaction. To close off our discussion on this IPSAS, let's take a look at subsequent measurement now. IPSAS 16 permits two approaches to subsequent measurement. An entity chooses as its accounting policy either the fair value model or the cost model and applies that policy to all of its investment property.
And Iman, what if an entity wants to change its accounting policy? Is that possible?
That's a very good question. IPSAS 3 accounting policies, changes in accounting estimates and errors, allows an entity to subsequently change its accounting policy where this will produce reliable and more relevant information. However, IPSAS 16 notes that it is highly unlikely that a change from a fair value model to a cost model will result in more relevant presentation. After initial recognition, an entity that chooses the cost model shall measure all of its investment property in accordance with IPSAS 17. Requirements for that model, such as cost less any accumulated depreciation and any accumulated impairment losses. This takes us to the end of IPSAS 16.
Thank you. At this point, I'd like to thank you, Iman, and Camilla for providing us insights into some of the IPSASB's asset standards.